Inflation numbers, big mergers, IPOs, but they were all overshadowed by war in the Middle East. This is Bloomberg Wall Street Week. I'm David Weston. This week, Richard Haass of Centerview Partners on Israel's war against Hamas in Gaza. Special contributor Larry Summers on the controversy over Harvard's position on the war.
A statement by 30 student groups blaming all violence on Israel was a moral absurdity.
And Greg Fleming of Rockefeller Capital Management on how investors respond to geopolitical turmoil.
Investors, David, have a hard time measuring geopolitical risk.
Global Wall Street began the week trying to absorb the awful news coming out of Israel and Hamas' terrorist attack on civilians and military, as word came of death and destruction.
It's simply depravity in the worst imaginable way.
And the initial Israeli response with more on the way.
Out of an understanding that there are civilians here whom are not our enemy and we do not want to target them, we are asking them to evacuate so that we will be able to continue to strike military targets belonging to Hamas in the Gaza Strip.
Even as we kept one eye on Israel, the world of finance and business went on, with a major merger in the oil industry between Exxon and Pioneer.
You have to become a diversified company.
It slots right into our existing unconventional business.
Another initial public offering came to market, this one from Birkenstock.
The first trade was at 41 bucks. This deal got priced at 46. So you're talking about an 11% decline for the open.
The critical CPI numbers came in on Thursday, the last read before the Fed's meeting next month.
The numbers come in a little bit hotter than anticipated, with CPI up 0.4. The forecast was for a 0.3 increase, but that's down from 0.6 the months before. The core comes in up 0.3, which is bang on.
In the end, the markets reacted to all the turmoil this week with surprising calm. But before we go through the markets, we begin with the big story of the week. And for that, we welcome Richard Haass, now of Centerview Partners. Until recently, Ambassador Haass served as president of the Council of Foreign Relations for almost 20 years. So, Richard, thank you so much for being here. You have a new newsletter out called Home and Away on Substack. You write today about this subject. And one of the things you warn about is if Israel, in fact, goes into Gaza, it could create more problems than it solves. Explain.
Well, don't get me wrong, David. I believe Israel should get involved in Gaza. It should go after those who undertook these heinous, barbaric acts. It's important to say that terrorists cannot act with impunity. Israel also needs to restore deterrence, rebuild its defenses, which obviously failed. But to go in really big, I do worry, would cause at least as many, if not more, problems than it would solve. You'd create a lot of sympathy for the Palestinians and for Hamas, because there would inevitably be all sorts of civilian casualties. Israel itself would take many more casualties. Its military, some of them would be abducted. I worry this could become the grounds for war widening, that in Lebanon and other places, Iran, using Hezbollah there, would take this as something of an opportunity. I think the United States, which has been rightfully so supportive of Israel up to now, would be pressured to rethink its position, maybe call for a ceasefire. So Israel really needs to think about what it does. The good news, Israel does have options, and I would say what it ought to do is really two things. It ought to go in, but very discreetly. Where it has intelligence, go after those Hamas fighters, could be very targeted on them, could be from the air, could be from the ground with small units. Secondly, rebuild your defenses. They failed. Rebuild the walls, put troops there, increase your readiness. Don't underestimate Hamas ever again. But in Western Israel, be prepared potentially for next time, if only because you don't want there to be a next time.
Talk about the specific objective of any sort of invasion of Gaza. It's understandable that Prime Minister Netanyahu must act, as you say. What was done by Hamas is beyond inexcusable. It's just inconceivable what happened. At the same time, the Prime Minister has said he wants to eliminate Hamas. Is that a realistic objective in Gaza?
Short answer is no. It's going to be very hard to find Hamas. It's not like it's an army in an open battlefield with tanks and planes and the rest. It doesn't work that way. Also, Hamas is as much a movement or network. It's even an idea, David. So it's not just that you're going to create all sorts of resistance. Remember Donald Rumsfeld's quote when we were using drones to kill terrorists? How do we know we're not creating more future terrorists than the ones we're getting? I think that would come into play. So Hamas or some organization like it, some movement like it, will survive, might even be stronger afterwards. And as the Israelis learned in many places, in Lebanon or in Gaza historically, easier to get in than it is to get out. And when you get out, how do you know you can put something better that endures in its place? So again, Israel needs to act, but it needs to act smart. It needs to act in a really careful way.
You know Gaza. You've been to Gaza City. You know how difficult that terrain is, as it were. It's so densely populated, so many buildings. One of the objectives here is to rescue the hostages, of which we don't know how many there are, but upwards of 100 at least hostages. Is that realistic? Is it conceivable that they could go in and actually rescue the hostages?
Really hard to rescue hostages. You need totally good intelligence. Then you need total surprise. That's loading assumption on assumption. I think the more likely way the hostages get out is there's a swap. You've got hundreds of Hamas operatives in Israeli prisons, thousands of Palestinians from the West Bank who the Israelis have charged with crimes. So I think if there's an exchange here, that would be the way it would work. Indeed, David, one of the reasons I would argue, one of the two reasons Hamas took so many hostages was, one, to deter Israeli attacks, but secondly, to set up this kind of a swap.
Richard, you mentioned the possibility of expanding this conflict beyond Israel and Gaza. And obviously, this is first and foremost a humanitarian issue, a tragedy, an inconceivable tragedy. It also has potential economic ramifications, particularly if there's expansion. What about, you mentioned Lebanon, you mentioned particularly Iran, because a lot of people on Wall Street are very concerned if this goes, for example, to involve Iran, then it could really have substantial economic effects.
Well, they ought to be worried about that, and that's why, again, it's so important this not widen. I think the United States ought to let Iran know that it will be held accountable for anything that Hezbollah does. Hezbollah is not an independent entity. I think we maybe ought to get the Chinese involved. China is the principal importer of Iranian oil. If the Chinese don't want to see that oil flow interrupted by American arms, they may want to lean on Iran to rein in Hezbollah. There's things we can and should do here because this could grow in other ways too, David. You can imagine Arab regimes around the region threatened potentially by public unrest if things get bad enough in Gaza. So in the Middle East, one of the rules of history, as bad as things get, they can always get worse. That ought to be one of our goals here. By our, I mean the United States and Israel, to manage this.
Richard, you are a career diplomat, and from what I've read of history, typically these things are resolved ultimately through some sort of agreement, not through out-and-out war and destruction of the other side. It's too early to really move forward, I'm sure, on diplomacy, but it may not be too early to think about what that might look like down the road and position ourselves.
I think you have to think about tranches or phases. We talked about one, which is a prisoner for hostage swap. I can imagine some kind of a ceasefire or modus vivendi agreement. The big question, though, is how do you make some progress on the Palestinian issue? Wildly optimistic, ambitious, I get it. But I think what we've learned, David, is normalization between Israel and Arab governments can only go so far. It can't survive, if you will, absent or apart from the Palestinians totally. There's got to be a Palestinian dimension to this. It won't be with Hamas. They have ruled themselves out for time immemorial. But Israel needs a Palestinian partner. Israel needs a Palestinian state, not as a favor to the Palestinians, as a favor to itself. If Israel is going to remain a democratic, Jewish, secure, prosperous state, it needs a Palestinian state that's willing to coexist with it peacefully. That has to be the long-term goal of Israeli and American foreign policy and diplomacy. I know how difficult it is. I spent decades working on it. But I think what we've learned the hard way the last few days, in a vacuum where there is no hope, then if the only game in town is terrorists, terrorists will do what terrorists do. And we can't allow that to be the only game in town.
There are those who speculate, we can't know, certainly I can't know what was really on Hamas's mind, but there are those who speculate part of the triggering event here were reports about a possible arrangement with Saudi Arabia, Israel, and the United States. Even at this late date, and understanding Saudi Arabia right now has said they're going to suspend the talks about really reconciling with Israel. Is there a potential constructive role for Saudi Arabia in the sort of solution you described?
First of all, I think you're right. I think Hamas, at Iran's behest, probably wanted to interrupt normalization. Hamas also wanted to do its version of station identification. They like to portray themselves as the only Palestinian entity willing and able to take on Israel. Look, Saudi Arabia, the Crown Prince, MBS, wants to normalize with Israel. He can't in this setting right now. It's too volatile. The Palestinian angle's too uncertain. But, and it's important, but they still want to do it. Saudi Arabia wants the security pact with the United States. They want a nuclear program that the United States supports. So yes, I think we ought to get Saudi Arabia involved, and that could be one of the ways, again, to work with Israel, which wants normalization with Saudi Arabia. That's one of the reasons Israel might need to think more creatively about what they hold out as a possibility to Palestinians who are willing to live with it in peace.
Richard, thank you so very much for spending time with us. That is Richard Haass, now of Centerview Partners. Coming up, we go through the market reaction to a very busy week with Mona Mahajan of Edward Jones. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. There was plenty for the markets to digest this week, including but going beyond events in the Middle East. In the end, the S&P 500 was up almost 0.5% to end at 4328, while the NASDAQ lost almost 0.2%, while the real ups and downs really were once again over in the bond market, with the yield on the 10-year starting the week up over 4.80 and giving up over 18 basis points in a shortened trading week to end up at 4.62. To take us through what we saw, we welcome back now Mona Mahajan. She is Edward Jones Senior Investment Strategist. Mona, great to have you back with us. Let's start with that bond activity. It has been pretty busy in the bond market in the last couple of weeks. Last week we saw the yields go way up. This week they came in. What was the cause of it, as far as you could say? How much of that was safe haven because of the geopolitical turmoil?
Yeah, thanks, David. What a harrowing week in the headlines. But to your point, markets held in there. There was a lot of resilience coming out of the broader S&P 500 in particular. And we do think part of that was driven by this flight to safety or safe haven response. So typically, when a geopolitical crisis hits, you see investors flock towards areas like the dollar, like gold, and like Treasury bonds. So all three of those played out this week, but most notable for markets was the flight to Treasury bonds, which pushed yields notably lower. So as you just showed in that chart, yields had been climbing almost to highs of this cycle just as of last week, and this week they reversed that course. So that brought some much needed relief for broader equity markets. And it's interesting, even though equity markets did end up higher, where did people and where did investors hang out? Well, we really saw outperformance come from the defensive parts of the market, areas like consumer staples, like utilities, some of those interest rate sensitive parts of the market like real estate. So it wasn't necessarily a tech driven or AI rally that we've seen really in recent weeks as well. So more broadly, we'd say this move in Treasury yields was partly a flight to safety response, partly maybe last week was a top in the near term for yields. We certainly heard a couple of Fed officials this week talk about maybe a pause in the rate hiking cycle. We do think there may be some volatility ahead, especially as there's uncertainty around these auctions that are coming up. But more broadly, we think the trend over time could be stability and hopefully a move lower.
So let's talk about that, Mona, specifically. You talked about highs of the cycle and a top. What leads you to believe that maybe that's what we've seen? We also got some CPI numbers that were a little bit high this week, a little hot. We had University of Michigan sentiment coming in with increased expectations of inflation. So what makes you think that maybe we've seen the high of the cycle on the 10-year?
Yeah, it was interesting. The inflation prints were certainly mixed. We had, again, a little bit of a tick higher in headline inflation and, the gradual move lower in core inflation. But even despite the mixed inflation numbers, which normally would have spooked markets and driven Treasury yields higher, we saw a pretty muted response. So Treasury yields were steady. Today, we actually saw another move lower. And in our view, while we do think there's volatility always around the bond market, we do think the Fed and really global central banks may be looking towards a pause. The Fed has already talked about rate cuts in 2024. Now, what are some of the counters to this? Well, certainly the U.S. has incurred a lot of deficits over time, and those deficits will have to be funded. And we've seen that, this week we had a 30-year yield auction. There wasn't as much demand as we had hoped. That did temporarily drive yields higher. And we saw sell-off in the market. So we may get bouts of volatility like that, but we think generally the direction of travel, especially as the Fed, it's very much doing the quantitative tightening now. It's not a big buyer in the bond space, but over time that program may stabilize as well. So we do think over time we'll see central banks kind of coordinate in a pause and pivot lower, which will put some downward pressure on the bond yield space.
That's just what I was going to ask about, is the volatility in the bond market, and particularly on the long end in the 30-year that we've seen. As you say, there aren't as many buyers because the Fed is out of the game, and there are questions about what's going on with China and Japan as well. At the same time, the supply is really, really large. Are you concerned at all about increased volatility in the bond market, or do you think it's going to settle back down? If why?
Yeah, what we'd say broadly is the environment we really had that propels a lot of these, growth stocks and risk appetite over the last 10 years, post-financial crisis, was an environment where the Fed was closer to the zero bound and Treasury yields were in the 1.5% to 2% range. When we think about the next 10 years, it could look very different. So to your point, we don't expect the Fed to go back to the zero bound, and we do think Treasuries may remain elevated versus history, so maybe somewhere in the 3% to 4% range. So in that environment, you really do have to think about asset allocation maybe a bit differently. Growth and value, or maybe a combination of both, makes more sense. And certainly bonds have a better or more substantial role in your portfolio. You can now get yields. You can now get some potential for appreciation if over time we do get Treasury yields moving lower. That does support investment grade and longer duration bonds as well. So what we'd say overall is while we may not stay at these elevated levels, we certainly don't expect to return to where we saw in the last decade as well.
You're also getting a yield out of cash or cash equivalents like CDs and things like that. Are your clients going into CDs? Because it can be pretty attractive right now, and goodness knows it's pretty flexible. Not much risk there.
Yeah, it is certainly interesting, especially when we get these headlines and volatility, politics, geopolitics. There is this natural response. Should I just hide out in these CDs? They're offering 5% plus. Our response is always, look, they are attractive for now. They have some interesting yields, really what we haven't seen in any time in recent history. So we understand the appeal. But for long-term investors, there's a few risks. One, reinvestment risk. So over time, those yields may not be there. They may start moving lower. So when you have to reinvest those CDs, it may be a lower rate. Two, there's an opportunity cost. And we've already seen the S&P 500 up about 12% this year, even with the volatility. And so, already it's exceeded that 5% or so cash-like yield. And then thirdly, we've seen historically over time, cash relative to really any other asset class has underperformed. So for long-term investors, we would certainly recommend complementing slowly some of that CD cash-like money with longer duration parts of the market, with strategic asset allocations, that are aligned to your goals longer term. So that's what gets you to meet or exceed your financial
Quickly
goals
at the
over
end,
time.
do you need to go into bonds and for fear that maybe the Fed's going to start cutting rates?
We do think that there is an attractive opportunity, and really it's compelling versus any time in recent history for that longer duration part of the market in the investment grade space. And usually, historically, that period between a Fed pause and that first cut is your opportunity. Markets start pricing it in very quickly as the Fed starts signaling rate cuts ahead. So we think the months ahead could provide that window of opportunity for bond investors, really like we haven't seen in recent years. And so we do think there's a compelling opportunity for bond investors in the months ahead.
Provided we actually get to that pause. Thank you so much to Mona Mahajan of Edward Jones. Coming up, Harvard in the middle of an explosive situation in the Middle East. What should we expect of one of America's leading institutions? We ask one of its former presidents, Larry Summers.
We've got to keep a sense of proportion here. We've got to keep the temperature down.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. The tragic war in Israel inflamed sentiments around the world, and as people very publicly chose sides, it drew some institutions into the controversy, including Harvard, which even its former president, Larry Summers, took issue with.
The statement by 30 student groups blaming all violence on Israel was a moral absurdity that appeared to reflect views at Harvard. And I thought it was very important that the Harvard administration, the Harvard leadership, made clear that those students were not speaking for the Harvard community. And at the same time, in the same way that previous leaders flew the Ukrainian flag over Harvard Yard after Putin's invasion, in the same way that Harvard stood with America after 9/11, I thought it was appropriate for there to be a strong Harvard statement condemning in the strongest possible terms Hamas terrorism. And after a couple of days without such a statement, I expressed my view publicly, having expressed it privately before. There was an initial statement that, frankly, wasn't very strong and didn't distance Harvard from the student groups. And now I'm glad to report that President Gay has condemned terrorism in strong terms and has distanced Harvard from the 30-student group. So the kind of leadership response that I was looking for has now happened. There's still a lot of uncertainty and confusion, and so these are not going to be easy days to navigate, and there are agonizingly difficult questions around the response. On the one hand, there's a right of self-defense and a right of response. On the other hand, when Hamas is using human shields, is using hostages as human shields, there are incredibly difficult questions about the appropriate and prudent and morally right response.
You're not alone in taking issue here. Your fellow Harvard economist Jason Furman has spoken out as well. But also we have Bill Ackman, who says it's not enough just to speak out at this point. We should know the names of the students who participated in these statements because future employers should take that into account in their employment. Do you think it should go that far?
I think Bill's getting a bit carried away. Look, David, this letter was issued 6 hours after the attacks. Many in the groups had no idea that there was going to be a letter. Some who probably signed their groups on didn't fully know what they were signing. Some, I'm sure, were naive and stupid. I don't think this is a time for individual vilification. It's not a time for demonizing Israel, and it's not a time for demonizing students who weren't careful or who were silly in what they did. That's very important to maintaining a community. Bill's entirely right, and I would do the same thing as he does in wanting to make sure that the people I hired weren't people who stood with hate. But asking for lists of names, that's the stuff of Joe McCarthy, not the stuff, not what I think strong business organizations or universities like Harvard should be doing. I think we've got to keep a sense of proportion here. We've got to keep the temperature down. There are incredibly hard questions ahead of us around the response, and they're not going to be any good answers, but we may find less tragically bad answers if we can recognize the clear moral lines and then beyond that support open debate.
Thanks to our special contributor, Larry Summers of Harvard. Coming up, we turn to the world of real estate in a time of higher rates with Cathy Marcus, co-CEO of PGIM Real Estate.
I think sellers are having a very tough time coming to term with the new prices.
That's next on Wall Street Week on Bloomberg. Repricing the world. That's what sharply higher rates mean for just about every asset class.
Starting in the mid-60s, you had an inverse correlation between bond yields and stock prices. Then you went for about a 20-25 year period where for most of the time you had a positive correlation. We're back in negative correlation territory.
We're seeing it in stocks.
My observation over, 40 years or so of watching equity markets is that they are keenly attuned to interest rates as a more direct transmission mechanism to equity prices, simply because interest rates are a discount rate on future cash flows.
We're seeing it in the drop-off in M&A activity as sellers come to terms with the new lower prices that buyers are willing to pay.
We're certainly beginning to see a significantly greater amount of activity. It hasn't manifested itself yet in announced transactions, but announced M&A for the first 6 months of the year was down.
And boy, are we seeing it in bonds.
We're more or less in the range for Treasuries that we're going to see.
But perhaps no asset class has been hit harder by the jump in rates than real estate, and in particular, commercial real estate.
Financing is harder to get today because of concerns about real estate, and also buildings have to have strong cash flows to support the higher interest rates that are associated with financing.
Leaving investors to wonder whether now's the time to pick up some bargains or whether they'd be trying to catch a falling knife.
I think the banks in the U.S. will lose $250 billion in office over time here. And there's about $2 trillion of equity in the banks. So it's like a 10% hit to U.S. banking equity. But I really think the focus on losses in U.S. commercial real estate is going to be in the office sector. And to sort through the bargains from the falling knives in real estate, we welcome now somebody who knows the area terribly well, Cathy Marcus. She is PGIM Real Estate Co-CEO and Global COO. Cathy, welcome to Wall Street Week. Great to have you here.
Thank you.
So a lot's gone on with real estate, in part because of what's gone on with rates. Start with the beginning question. There's been sort of a repricing of real estate because of those higher rates. Where are we in that process?
Well, there are really two parallel repricings that are going on right now. One which has already happened and potentially overcorrected a little bit, which are the public real estate markets, the REIT market, and then the private real estate markets, which have taken much more time, and where we might be, call it 60 to 70% through, and that is an average because the different sectors are behaving very, very differently. The fundamentals are very different among the different sectors, and the impact that rates have had on the valuations and the private valuation process in general is a little bit different, and the experiences have been different for the different sectors.
On the private side, are sellers having a tough time coming to terms with the new prices?
I think sellers are having a very tough time coming to term with the new prices, and the gap between where buyers and sellers think things should trade, and then overlay that with where the lenders may or may not be willing to lend. It's the transactions market is so muted right now. I can't actually remember a time that it's been this muted before, and it's only gotten worse since rates have spiked, really just recently.
Well, if you have to refinance in this world, it's a very different world from just 2 or 3 years ago. At what point do a lot of the sellers have to refinance and it really has to change what's going on?
Well, that will happen over time, and there are, maturities that are coming up. There are maturities that have already occurred, where there's been a bit of a kicking the can down the road, particularly in the office sector. So if you think about it, an office loan matures, and so what normally happens? You could refinance that office asset, generally at the same or a higher loan balance, or you could sell the asset. Neither one of those things is really possible right now. The option that's available to people right now is to potentially extend the loan, and often that requires some sort of an equity pay down, which generally, particularly in the office space, is not that appealing to borrowers because in some cases they feel like they're throwing good money after bad.
So that's office space. As you suggested, there are a lot of different parts that come under real estate, and there's a big variety. Where are there some opportunities out there right now that you're interested in, particularly within the broader real estate market?
I'm really glad you mentioned that because it is definitely a common misconception that the office sector dominates the investable universe in real estate. And that's not the case. It's never been the case that it's dominated. It certainly has been higher than it is right now, but in the private markets, If allocations to office were in the high 40% range, they're now about 20%. And in the public markets, the percentage of the REIT index that is pure office is hovering somewhere around 5%. So it is far less of a sort of 800-pound gorilla than it was at one point. But I do think that gets a little bit overblown. In terms of where we see opportunity right now, the operative term is necessity. Things like housing, things like grocery-anchored retail, things like infill logistics. So the basic necessities of life, we call them sort of necessity retail, necessity properties. It's food, shelter, and your Amazon deliveries, right? The things that nobody can live without.
Talk about shelter just for a moment, because we are hearing about the possibility that it's difficult or even impossible to get insurance for some housing now. Certainly we have issues in California, we've had them in Florida. How is that affecting the marketplace?
It's impacting all kinds of property. It's not just single-family homes, which is really where the headlines tend to be, but in certain markets in California, in Florida, so many insurers have pulled out of those markets because of all of the losses that they've had with climate issues over the past couple years, to the point that you're really talking about, like, order of magnitude, about 30% increases year over year for the past couple years in insurance coverage. So that's obviously very difficult for individual homeowners, but it's also difficult for investors.
Those of us who are based in the United States tend to be U.S.-centric in our thinking, and particularly when it comes to real estate.
Yes.
But there's real estate around the world. As you look around the world, do you see markets that are particular opportunities right now?
There's certainly markets where the dynamic is different, and that can create opportunity. And in particular, where I would say there's great opportunity is in Mexico in the industrial space, and particularly along the border. And you have a lot of multinational companies that are located there looking for logistics and distribution type space, and many of those leases are dollar denominated. So you have kind of the premium over a very similar, you can have an Amazon building south of the border or an Amazon building north of the border, and there's a pretty significant spread in those yields. So that I find to be very interesting, and we find that to be a very compelling investment right now. If I go to Asia, the markets are functioning much more normally in Asia than they are in the US and or Europe. And while transactions activity is definitely muted there, it's not in the same scale that it is in terms of the decrease for Europe and Asia. And Europe really, the repricing there, I think, is a little bit further along than it is in the US. But the interest rates, obviously are really impacting the European market. The European banks are pretty much out of the market from a lending perspective, and that has, I think, imposed a little bit even more stress on that market. And we have to consider the fact that while, the rising interest rates, we've been at about a little more than a year here in the US where that's had a huge impact, but Europe was, really immediately impacted by the Ukraine war. And so it's been just a longer period of distress in Europe.
I've heard it said, Cathy, that every business at this point is a tech business. I'm not sure if that's right, but certainly tech is changing every business. How is it changing your business?
It's changing our business in many, many ways. And you might have seen that we recently launched an innovation lab. And that is multi-pronged in terms of leveraging AI and data, in particular our proprietary data from our platform, in order to have better investment outcomes. But another really big and actually quite important aspect of the research and development and investment that we intend to do in technology through our lab with our university partners and with other technology companies is to address issues around climate and ESG. And it's very interesting in the real estate space because there really isn't that kind of controversy around ESG that you might find in other sectors. Having lower energy costs and using less water, that's just more income for you as an investor in real estate, and that's just going to improve your value. So we really have a great focus on that. And if you think about, how many companies have made net zero pledges by 2050, the only way to get there is really to have technology, to use technology, most of which does not exist right now. And some of the things that are really interesting that are being explored right now are things like green concrete and sensors that can sense all kinds of things. They could sense if someone maybe is having a heart attack. They could sense a water leak before a lot of damage is done, which, by the way, we were just talking about insurance. A lot of these technologies will help to, mitigate insurance costs because it'll mitigate losses. So there's so many really interesting things going on in technology right now around the globe, in real estate and really just around the built environment. So we're very excited about our new initiative.
Cathy, it's great to have you on Wall Street Week. Thank you for being here. That's Cathy Marcus. She's PGIM Real Estate co-CEO and global COO. Coming up, investors come to terms with higher rates, uncertain growth, and even great geopolitical risk. We get the view from someone putting money to work, Greg Fleming of Rockefeller Capital Management.
The big issue in a place like the Middle East today for investors is, does it expand? Will it move into a regional conflict?
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Investors are having a roller coaster ride so far this year, from higher rates for longer to a stock market on the march and then having some second thoughts to geopolitical risks that have now spread from Ukraine to Israel. To give us some guidance as to what the smart money is doing with all this, we welcome now Greg Fleming. He's founding president and CEO of Rockefeller Capital Management, which oversees some $112 billion in assets. So thanks so much for being back with us, Greg. Good to have you here.
Great to see you, David.
You have a particular viewpoint from an investor's point of view. You represent a lot of high net worth and ultra high net worth individuals. Start with geopolitics, because they're very much in the news right now. To what extent are those investors focused on geopolitical uncertainty? And if so, what do they do about it?
Well, investors, David, have a hard time measuring geopolitical risk. And history would suggest that a lot of the immediate downturn that occurs on the back of different geopolitical events tends to reverse over the following months. So the big issue in a place like the Middle East today for investors is, does it expand? Will it move into a regional conflict, bringing in nation states like Iran, and then ultimately impacting things like the price of oil that would have an impact on the global economy? If you look at local markets in the Middle East today, they've had a fairly moderate reaction, down a little bit. The Israeli stock market in Tel Aviv was off the first day, but has been in a range since, so that even the local players so far are measured in response. But our investors here in the U.S., no fundamental change at this point in time, other than sitting here and witnessing these unimaginable horrors that the rest of us are watching. From an investment standpoint, they're similar to where they were before this.
When you talk about fundamental change, we've seen a fundamental change in the rate structure. We were essentially with free money for an awful long time, essentially zero rates. Those days are gone. It looks like we're going to have higher rates for some time to come. How do your investors take that into account?
Well, that's a big impact on investors, and that's something that they're all digesting. So, at the outset, when you look at stocks and stock markets, the risk premium that stocks bring today now over other attractive alternatives, even cash, but munis, treasuries, things like private credit, which is a big growth area for us within our alternative business, that risk premium is down on equities. The reality is, with higher rates, growth companies, you're discounting back cash flows that are out there in the future that are going to grow between here and there. You're discounting them back at higher rates. So from an equity market standpoint, the higher rates are a serious headwind, particularly when you have the kind of alternative uses of investor dollars that we're seeing. And as I said, even cash, if you can get 5% on a risk-free basis in something that liquid, that presents a positive alternative for investors. The other thing I would say about higher rates is the impact from a fiscal standpoint, which I know you spent a lot of time looking at. On the current trajectory, interest payments on the federal budget will exceed military expenditures by 2027. So higher for longer has a big impact on the fiscal side of the equation, which is relevant to all investors, because the U.S. debt situation is definitely a concern.
And what overhang might that have for growth? Because your investors must be thinking about, what are our growth patterns? What are we looking at over the next 5, 10, 20 years?
Well, the U.S. economy is held in remarkably well. There's a number of reasons for that, including the fiscal spending. I mean, we're running a federal budget deficit now of 8% of GDP, and there is no recession. Typically, deficits go up when you have a recession. If we have a recession, you could see a double-digit deficit as a percentage of the federal budget. So with that kind of fiscal spending already embedded in the economy, will there be enough growth for investors in the U.S. market? It's a real concern that the fiscal side of the equation could be a headwind for investors going forward. So you have that investors are focused on. And then you have the Fed, who's obviously been raising rates to try to deal with inflation. Those higher rates are also working their way into the fiscal situation. So you have a headwind on the monetary policy side. You're likely to have an increasing headwind on the fiscal policy side. So investors look more cautiously at the medium-term outlook for the U.S.
Your high net and ultra high net worth investors must be thinking about taxation. And when you talk about the fiscal challenges we have in front of us, one possibility is higher taxes to raise more revenue. How do you invest around that potential?
You know, one of the things that we do with our investors is we work with them on a comprehensive basis across all of their needs. So we're helping them with generational work, we're helping them with estate planning, and already, even if taxes don't go up at some point in the future here, already you have tax cuts in 2017 that are scheduled to expire at the end of 2025. So we're spending a lot, and the estate deduction, the ability to leave money without paying an estate tax, that amount is coming down if those taxes are rolled back. So we're already spending a ton of time with clients on a longer-term basis looking at tax policy from that vantage point. So taxes are a big part of the work that we do. We have a group called our Wealth Strategies effort that works very closely with our private advisors and our clients on pre- and post-tax planning.
Talk to us about geography, both in terms of your customers and your clients, the money coming in for you to manage, as well as your investments going out. I know you have offices all around the world at this point. How much of it is U.S. based?
Our client base is almost entirely U.S. based, and our offices that work with high net worth and ultra high net worth clients are all in the U.S. We have a London office that is focused on distributing our asset management products through different intermediaries in Europe. So the Rockefeller Global Family Office business is really a U.S. business with U.S. clients. The reason that we've stayed focused on the U.S., even though we have this name, Rockefeller, which resonates not just in the U.S., but around the world, and we could be expanding outside the U.S. with that name more, is because the opportunity has been so significant for us here. The breadth and depth of wealth in the American market, the number of cities that we can open an office in, hire private advisors and start to build a business around is significant. So it used to be, David, if you went back 10 or 20 years, there were 30 or so markets in the U.S. that would be quite attractive for helping high net worth clients. Today, we're in 47, and we could end up with over 50. There are relatively new markets that are quite strong from a growth standpoint, creating a lot of wealth for different families in places like Nashville and Austin and Charlotte. So we've really expanded the footprint to include some of these real growth areas within the American financial market.
And what about investment opportunities? I mean, at this point, for example, China is not as attractive for many investors as it once was. If you look at direct foreign investment, it's really gone down substantially. But what are you looking at globally, United States versus Europe versus Asia?
Well, first of all, the U.S. Continues to outperform on a lot of bases, and the economy has been very resilient in the face of 500 basis points of Fed increases. Now, part of that, again, goes back to the fiscal stimulus that's embedded in the system, the payments to individuals during the pandemic, and that's still in the system a little bit. So the U.S. remains an attractive base for a lot of our investors. On an international basis, the rivalry between the U.S. and China has created some other markets that are more attractive when you look at emerging markets, including places like Vietnam and Indonesia. And there are going to be markets that kind of, in Mexico, where more things are being made there again, and some of the restrictions that have been applied to China have benefited the Mexican economy. So as the U.S. and China continue to face off against each other in different ways, there will be economies around the world that benefit from that. Some of the places that have been challenged for a while are still challenged. I mean, Europe is probably the most difficult place in terms of growth and investing for our clients.
Greg, really great to have you back on Wall Street Week. Thank you for being here. It's Greg Fleming of Rockefeller Capital Management. Coming up, a deadly game of chess plays out in the Middle East. We go through the moves with Bloomberg's senior markets editor, John Authers. That's next on Wall Street Week on Bloomberg. Our one more thought this week comes from our senior markets editor, John Authers.
At this point, I think we're fully discounting the obvious next step, which is that this will lead to a broader Israeli incursion into the Gaza Strip and what could obviously be quite an ugly land war. But the idea that that is going to have any collateral consequences or that it's going to spread into southern Lebanon, Hezbollah, Iran, most significantly, at this point, I would say isn't priced in by the markets at all. I'm not saying it should be priced in as 100% as a certainty, but the risks are so great that we do get that kind of escalation that I'm surprised markets are as calm as they are. If it spreads to Iran, that's the single biggest question. And once it spreads to Iran, again, it depends exactly how it does so, how far it goes. But then comparisons to the Yom Kippur War in 1973 at least become possible. If we're talking about a conflict that disables their ability somehow or other to export oil, that does matter because part of how oil prices have relatively stabilized since the Ukraine invasion. There are many reasons behind that. One of them is that Iran really has been coming back online. The Iranian oil exports have increased. If you take them right back down again, that is a big issue for the oil price. Not as important as it was in 1973, but still very important. If you have an expansion that then requires other countries that in the region that aren't necessarily friends of Iran, but can't look by as Israel moves beyond its borders, then obviously the situation gets very alarming indeed. No predictions here. If this were to happen, it's still a way off. But if the attempts to come to a deal with Saudi Arabia, between Saudi Arabia and Israel, really are definitively scuppered, that is quite a problem. This time around, it's hard to see. You can see why the Israeli aim after the appalling things that Hamas has just done would be to eliminate Hamas. You can also see that that's going to be really difficult to do and possibly, arguably impossible to do without causing the kind of civilian casualties that other people are not going to be able to tolerate, that will create a broader disturbance across the region. I don't really see. It would be wonderful if there was some kind of a deal whereby even the Saudi Arabians felt comfortable to recognize Israel. That's conceivable, but the whole point of this exercise appears to have been to stop that from happening. Obviously, it would be really wonderful if the Israeli-Palestinian question itself could be resolved. I don't myself see how these appalling events have brought that any closer. The idea that an outcome in which both Israelis and Palestinians consider to be just and fair is further away than ever, which is a tragedy. But I just don't quite see how that kind of a positive outcome is available, how we would expect to get there from here.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.